How do you know what a company owns? How do you know how much debt a company has? How do you know how much is owed to the shareholders? If these are questions you've asked before, then this lesson is for you. We can answer all these questions by looking at the balance sheet. The balance sheet, also known as a statement of financial position, is one of the three main financial statements, the other two being the income statement and the cash flow statement. Unlike the income statement and cash flow statement, which will show you what happened over a period of time, say the 1st of January to the 31st of March, the balance sheet provides a snapshot at a particular point in time, say the 30th of June. A company will usually show their balance sheet at the end of every quarter and year. The balance sheet tells you what the company owns, these are called assets, what the company owes to lenders, these are called liabilities, and the difference between the two. This is called shareholder equity. This is what is owed to the shareholders. You can think of the balance sheet like your net worth. You have the things you own, these are your assets, things such as your car, your home, and your savings. You have the things you owe. These are your liabilities, things such as your credit card debt, your car loan, or your mortgage. Lastly, you have your net worth. This is your equity. To calculate your equity, you subtract your liabilities from your assets. The most common time you will hear about equity is when it comes to owning a home. Say you want to buy a house. The house costs $500,000. You have $100,000 saved in your bank account. In order to buy the house, you get a $400,000 mortgage from the bank and use $100,000 in savings. In this scenario, how much are your assets, liabilities, and equity? Pause here while you work it out. Your assets are $500,000, the value of the house. Your liabilities are $400,000, the mortgage from the bank. Your equity is the difference between the two. $500,000 minus $400,000 equals $100,000. The balance sheet has two sides. On one side, we have the assets. On the other side of the balance sheet are the liabilities and the shareholders' equity. The important thing about the balance sheet is that the value of the left side must be equal to the value of the right side. That is, the value of the assets must be equal to the value of the liabilities plus the shareholder equity. It must balance. Why are liabilities and shareholder equity on the same side? Think of assets as the things that the company owns. The company must pay for these things in some way. The way that it pays for them is through liabilities, which is money owed to lenders, or through shareholder equity, which is money owed to shareholders. It's like the earlier house example. You wanted to buy an asset, the house. In order to pay for the asset, you needed to use equity, which was the money you had saved, and liabilities, the mortgage from the bank. A very simple balance sheet will look like this. Balance sheets are usually broken down even further though. Assets are split into two categories, current assets and non-current assets. Current assets include cash or things that will be converted to cash within the next 12 months. Current assets include things such as cash and equivalents, short-term bonds, inventory, and receivables. Non-current assets are things which are not expected to be converted into cash within the next 12 months. Things you can touch, called tangible assets. These are things such as property and equipment, and things you can't touch, called intangible assets. This includes things such as intellectual property. Liabilities are also split into current liabilities and non-current liabilities. Current liabilities are expected to be paid off within the next 12 months, such as short-term debt and accounts payable. Non-current liabilities are not expected to be paid off within the next 12 months, such as long-term debt. Lastly, shareholder equity is the money owed to shareholders. This includes the money shareholders have invested into the business, as well as retained earnings, which are profits the company has generated but not paid out to shareholders. Current assets and current liabilities tell you more about the day-to-day operations of the business. Non-current assets and non-current liabilities tell you more about the long-term strategy or position of the company. Let's look at the balance sheet of a real company. Here is the balance sheet for Nike as of the 31st of May 2023. Instead of a left and right side, we can split the top and bottom. At the top we have the assets. Luckily, we don't need to add them up ourselves. We can see total assets here equal 37,531. That number is in millions, so it's actually 37.5 billion. Nike doesn't list a line for total liabilities, but they do list a line for total shareholder equity. Total shareholder equity is 14,004, or 14 billion. We can calculate total liabilities in two ways. One way is to add up all the individual liability items, but we have an easier way. We know that liabilities plus shareholder equity must equal assets. So if we subtract shareholder equity from assets, we will have liabilities. Total assets are $37,531. Total shareholder equity is $14,004. $37,531 minus $14,004 is $23,527. Nike's total liabilities as of 31 of May 2023 were $23.5 billion. Finally, we can check that the balance sheet balances by looking at the bottom. Total liabilities and shareholder equity equals $37,531. This is equal to the total assets, which is $37,531. As you can see from Nike's balance sheet, there are lots of different line items. Over the next few lessons, I'll be breaking down the most common items found on the balance sheet, what they are, as well as useful numbers and ratios we can calculate from them to help us analyze companies and stocks. Let's summarize. The balance sheet provides a snapshot at a particular point in time. The balance sheet shows us what a company owns, the assets, what it owes to lenders, the liabilities, and what it owes to shareholders, the shareholder equity. To calculate shareholder equity, we can subtract the liabilities from the assets. Another way to put it is assets equal liabilities plus shareholder equity. Assets can be broken down into current assets and non-current assets. Current assets are expected to be converted to cash within the next 12 months. Non-current assets are not expected to be converted to cash within the next 12 months. Liabilities can be broken down into current liabilities and non-current liabilities. Current liabilities are expected to be paid off within the next 12 months. Non-current liabilities are not expected to be paid off within the next 12 months. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.